Okay, welcome to Traders Group. This evening, we've got some pretty exciting moves in the market occurring, and I'm probably the most buoyant I've ever been. And I know since in the last few months, there's some good money being made, both from the perspective of investors and traders. This is the time to be making really good money as a trader, picking up these swings on the market, and as an investor. I seem to be hitting record levels on my investment accounts all the time. So I don't want to put the mockers on it, but I'm probably going to break a record coming up in the next week and a half, and I'm talking the end of the Australian financial year. We'll see how we go. So let's just examine the S&P 500, and what we have is what we basically said last week will probably happen, and that is that the market 5 days ago was extended way above its moving average, and markets that have a position way above the moving average have a tendency to revert back to the average, and essentially that's exactly what's happened. You'd have to ask yourself, is that it? Is the market going to find a level of support at the moving average and bounce? Well, first of all, let me draw in the pretty basic trend line I put in last week that cut through a lot of in fact, that's not correct. Just give me one moment. I'm just trying to do a line of best fit. I think that's probably the line of best fit. On this chart, we can see that, yes, the market has come back. I want you to closely look at the last two pullbacks. You can do a time count and you can do a bit of pattern recognition. I'm looking at the first one in mid-April, and I'm going to just count it live. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It was basically 11 days on the counter trend. Now I'm going to count the next counter trend in mid-May. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're talking about a 11 or 12 day pullback for a counter trend within the S&P 500. And as we can see, we've only had roughly 5 or 6 days in this current pullback. So my best guess is this isn't finished. It hasn't reached that trend line that I drew, not that it has to. I can't make it, but there's something else I just want to show you. It's going to get rid of the bit of the clutter just for a moment. And that is on every pullback, I don't care where I am in the markets. Let's get rid of everything. What I normally observe is a market that falls, a market that rallies, a market that it's low. It's called a three-wave structure. And it doesn't matter where we are in the markets, it always does this. Has its fall, has its rally, has its fall into the trend line. So here we are. We can see that the time count is not complete if it is to continue with that roughly 11-day, 12-day time count, and it hasn't done a three-wave structure. So my best guess is it probably has a little bit more to go. And this time next week, if I'm right, which will be unfortunate, the market will be at that bottom trend line, or what would be fantastic, it ignores it and goes straight up into the end of our financial year and drags my portfolio with it. I don't care what actually happens because I've already hit a record at the moment. So it's fine. It looks good and it looks extremely bullish. When I look at the volume picture on the S&P 500, obviously the bigger picture is really strong, and there has been a bit of slight institutional volume weakness in the past week, which indicates there is still room for this market to back off. So don't get too excited going hard long with your trading until this is finished, because the optimum point to take a trade in the next few weeks will be if the market does exactly what I said and you get these extensions in the market. If you can start picking up these extensions, there's some really big money to be made, and this could go on for days, weeks, and months. Now, it seems like everything Mr. Trump does adds benefit to the US markets. Even when he's ratcheting up trade wars with China, it appears the Chinese are suffering, and America, according to the equities market, seems to be liking what he's doing because it continues to go up. Is it rocketing and roaring up? No, it's not. It's actually quite a low momentum rally, but who cares? It's still rallying. It's looking good, and there's no indications of anything other than what was a huge accumulation phase and an expansion with no fear. The only thing that I would look as last night, there was a little bit of a rally in the VIX, but that's to be expected if I'm still anticipating a slight counter trend to complete itself within this market. There is, though, one anomaly that I picked up today, and that is the mid-cap stocks in the United States. When I look at the mid-cap stocks in the United States, they're gone ballistic. I've got to now go to a weekly chart, and they are disconnected from the S&P 500, breaking into a new high. I'm putting up a weekly chart for now the fifth week in a row. This is quite amazing. So if your portfolio is generally in mid-cap United States stocks, you would be doing exceptionally well at the moment. And that is not an abnormal story. Markets in mid-cap area tend to be a lot more volatile, and they often can lead the market. They are leading the market, but it's just an impressive, very big disconnect between the IWM and the S&P 500. There's not only a disconnect in price movement, there's also a disconnect in volume movement. When I look at volume movement, volume pressure, when I look at the volume pressure of the IWM, it's about 2 to 3 times as great as S&P 500. So it just tells me there's some enormous institutional buying in the mid-cap stocks in the United States, which is all good. There's nothing negative about this because it all supports an increasing upward, strongly trending US scene, which is just fantastic for us all. Especially, I think, KiwiSaver accounts and superannuation accounts in Australia. We want the market to rally for the next week and a half. Alan, is the New Zealand financial year, does that end the same as Australia? Could you tell me? Alan says yes. Okay, so we're in sync. We're not in sync with the US. We'll do sectors in a moment, but I already know what it's probably not. The answer to your question, Alan's question, is what is the sector breakdown that's driving IWM? It is two sectors that are driving the markets, whether it's IWM or S&P 500. The two major sectors are tech and consumer discretionary. It's actually the same as S&P 500. So if you looked at mid-cap stocks in those two areas, you'll find that's exactly what's driving this move. And they're both understandable, especially consumer discretionary, especially with full employment within the United States, historical full employment. People have got money to spend. You'll find there's wage. I haven't looked at the wage growth figures, but you'll find it's nothing like Australia. There'll be a strong wage growth within the United States, and the US is a consumer-driven economy. They'll be spending like crazy, and it's all good. It's good for them, and eventually it's good for the rest of us because they're the tugboat that appears to be dragging the rest of the world at the moment, which is unfortunate when we look at places like not unfortunate, but when we look at places like Germany. So let me look at EWG, and don't be fooled by this chart. When we look at this particular chart, it looks like it's breaking down, but you got to keep on reminding yourself this is high cap German stocks traded on NYSE in US dollars. Therefore, if you've got a strong US dollar against the euro, it's a negative impact on this chart, and that's what actually you're seeing. So it's probably not the best in these very strong currency movement environments to be looking at EWG to get a sense of Central Europe, when what we should be doing is looking at the DAX. The DAX is a beautiful accumulation phase. It has been for a while, has done a series of higher highs and higher lows, has stalled out a little bit in the last few weeks due to issues in Italy, but it is a trending market that's not breaking down. It's going up and is looking really good. The one economic block that isn't looking good is our friendly Chinese. First of all, I'll bring up FXI. I caution you once again, this is large cap stocks in China traded on NYSE. There is a currency effect on this chart. The chart is breaking down. probably, and I don't look at all the currency pairs, but the US dollar is going through the roof. So has to be a currency effect on all pairs against the United States currency. So the best thing though to do is to look at the Shanghai Composite. And when we look at the Shanghai Composite, it has had a major breakdown in the last week, which is not a shocker when we listen to the fundamentals on TV. What we're most aware is that Trump is ramping up his, it's not anti-Chinese, it's just his make America great again rhetoric, and this time it was 500 billion in tariffs aimed directly at the Chinese. And I don't know the detail, but my sense of it is I kind of agree with him. I think there is actually a big imbalance, and all as he's doing, he's not putting up trade barriers. That's not what he wants. What he wants, he's a business guy. He's asking for a better deal. They will do a better deal. Both countries will be happy. America will probably benefit more than the Chinese. But the Chinese, you wait to see them get on side or compromise. And the reason they have to compromise because their whole political system's based on continuing growth, driven and delivered by the friendly Communist Party. If they cannot deliver increased and continuous growth, especially in the past years, now that the populace has got used to it, they will have political instability and a call for democracy. That is a huge imperative for the Chinese government. They would be in a kind of panic mode. They don't show it, but they have always been under this pressure to deliver the goods, to ensure that the people look to the Central Committee as the guiding light or guiding element for the Chinese. So very interesting, and there's a lot of ripple effects from Trump, which could have unintended consequences. We'll see how this unfolds. I like it. Okay, so EWG and FXI, when I look at the volume numbers, and I've only got the exchange traded funds to look at volume information from, there's been in China, a significant shift in the volume behavior. Actually, it's quite dramatic. But I've got to take into effect, I'm looking at the exchange traded funds, not actually numbers for the actual index. So I'm just going to discount that information at the moment and not pay too much attention to volume. Let me come across to XJO and EWA. EWA, once again, we know it's an exchange traded fund. So once again, we also know there's probably a strong currency impact on this particular chart, and the channel that I drew up last week has broken to the downside, which is in stark contrast of XJO. Bill, I see you've got a question. I'll read it shortly. Which is in stark contrast to XJO. Let me bring up the chart, which is the primary focus for Australians and maybe our New Zealand friends. When we look at this particular chart, we can see, I think last week, if I could just open up the chart, we're expecting some sort of a bounce. I'm just cleaning up the chart a little bit. We're expecting some sort of a bounce at these levels, and it's precisely what we received. And the bounce has been rather dramatic. In fact, it's been that dramatic in the last week that we've seen the market reach the first extension that I drew up on screen last week, which is 0.618 at 62.19. So I would anticipate when you look at this chart, it's hit the first Fibonacci, which is usually a level of resistance, which in conjunction with its position way above a 20-period moving average, which by the way is pointing up, we'll probably have a little bit of a rest and you'll see a little bit of a pullback into next week, which again is unfortunate. I'd love to see it expanding, and it is very, very, very strong, and I believe it's breaking into new highs in comparison to the last, I don't know, I think I heard on tally, last 7 or 10 years, which is great. Why? Is what I would ask, and answer the question is exactly what we were talking about last week. For this market to make a decent move, we needed two of the biggest sectors within the Australian market to work in tandem. My view is, and I'm repeating myself from last week, that we are in a roaring bull market in Australia, but the roaring bull market was hidden at an index level by the detrimental effect of the banking sector within the banking industry within the finance sector. And that has obviously changed within a week. Only last week, I was talking to you about the undervaluation of the banks. And when big funds decide via their models that undervaluation has gone way too far, they will come back in and they will ramp up this market, and right on cue, starting on the Friday or Monday, 4 or 5, but it was actually Friday, the markets have gone ballistic. So they must have listened to my recording or something. Irrelevant, it's silly. The thing is, it looks like it's producing a very large bottom. And I drew some silly looking charts last week, and I proposed that maybe this might end up being an inverted head and shoulders pattern. If it does, it will have a very strong rally on the upward leg. Well, it's like it's all come to pass. This really does look like an inverted head and shoulders pattern with a really strong rally, and it's reaching its neckline or is already at its neckline. Therefore, the next move in this market will probably be, that is finance, a sideways consolidation to complete the pattern before it makes another move. That sideways consolidation would fit with the index pulling back a little bit from its overextended position within the markets. If we come across to XFJ, it should look exactly the same, but I'm more interested in CBA as an example of one of the banks. I probably did need to look at this. It looks exactly the same. It looks like an inverted head and shoulders pattern. And by the way, I can't see into the future. This may turn out to be a W pattern with a big retest, but that's all the information we've got at the moment. It does look like it's breaking trend. It looks really interesting. Let's come across to CBA, which is the one bank that I would follow for a lead within the banking industries. And yes, it does look like a inverted head and shoulders pattern has formed up on CBA. So there's two things, or one thing, or major thing that's happened in the last week, and that is the banking sector's finally joined joined in this expansion. Metals and mining has been driving this expansion for days, weeks, and months, and has been extremely bullish with a slight pullback. All other sectors, as I pointed out last week, are in roaring bull markets. And this break that we're seeing has just fueled a major break in many of the sectors. Healthcare, major break. Information technology, major break. Consumer discretionary, major break. Energies, continuation of a move. Consumer staples, major break. REITs, which is a subset of finance, continuation of the move. Industrials, major break to the upside. The only weak sectors within our market now have been, and still are, I believe, telecoms, and we all know why. It's the dominance of Telstra and their failing business model, and utilities. Utilities is normally a defensive sector, and what we should find, it has had a short-term rally, but it will lose steam as the market grows, or it can go with the market, but it's not somewhere where I would be placing a great deal of money. So all this expansionary activity is not something that you have not been aware of for days, weeks, and months, and hopefully you've positioned your portfolio. I've just said that I'm going to do I think a record this year, which is just great. So when I look at EWA, I'm discounting any volume information I'm seeing. I'm just following the Aussie move, and let's go look at some sectors within these markets to see where we should be positioned, and if we're not positioned here, why are we not positioned? Okay. The strongest sectors in the US market, due to the move that we had over the last few months, is oil, Texas Light Crude, which is not a sector, it's just a subset of XLE. But I have told you I'm not convinced. And the reason I'm not convinced is in the last few weeks, although I've seen the energy sector rise, I've seen a major shift in institutional volume behavior that's supporting that move, and it has been dissipating and going negative, even though the index or some of the charts look like they're going up. When I look at the oil chart, it actually, I think I'm right. I didn't take any position within the energy complex, and I'm kind of glad I didn't, because I don't think I've missed out on anything. I missed out on maybe one little move. I didn't have any money anyway. And when I look at this particular market, it really does look like it has broken significantly below trend. This is USO. So it's come back nearly 50% of its move to the upside. This does look like a W pattern, but it's got the tendency and the possibility of continuing to break down based on volume. XLE is a similar story with not quite an M tot. It'll probably end up being a three-wave structure and then it'll be breaking up, but it's simply not the same as when we look at other sectors within the US market like finance, which has just been continually rocketing up. I'll show you the strongest sector just as a visual comparison. Consumer discretionary in the United States, it's just awesome. It kind of looks like IWM, breaking into new highs all the time, way above its average, and it can stay there for protracted periods, but it's due to pull back. Why? It's too far extended above that average. So oil is interesting, but I'm not involved. Let's get down to currencies, because the currency market is probably one of the most interesting and is looking very, very good. So I'll start with FXA. I'll bring it out to a weekly chart. I actually just jumped topics then. I've got to stop myself. I'm talking too fast. I apologize. I'm going to come back to the sector rotation chart. I got taken off on an energy tangent. Let's just stick on these charts. Okay, so what's the strongest two sectors on these charts? What's the strongest three sectors? I'm going to turn off everything that I don't like. There it is. Now, I turned off XME. Now I've got XME still on screen. So this would be where I would concentrate a portfolio, or where I'd be looking for opportunity for trading after this market index does its pullback in the S&P 500. And it is consumer discretionary. It is tech. It is XME. Has a little bit of weakness in the last week. That just represents a pullback. And XLF in the United States looks like finance in Australia, but I pointed out there are specific industries within XLF which are going crazy. They're not consumer discretionary, they're diversified financial stocks, or the diversified financial industry within finance is really strong. So if I turned off finance, that's where you should be concentrating your portfolio, and that's where I've got my portfolio concentrated. And select industries of select sectors if you can find strength. Coming across to the Australian market. Before I come off the US, I just want to make a point. Here's what's interesting about what I've just showed you. I've only showed you three sectors. I've shown you tech, discretionary, and materials. This is unusual. It's not absolutely normal for the US market to be so tightly defined by so few sectors. Is it predictive of anything? No, it's not, because the other sectors will kick in behind it. But I'm just saying it's supported with a very tight base at this point in time. And I've got to get to some of the questions being typed in. I will shortly. I'll just finish Australia. The reason I wanted to mention that, because the Australian market is completely different. The Australian market has got a broad base of very strong sectors, and you would want to, if you're in Australia, or you've got your portfolio in Australia, you want to be spread across everything. Healthcare, information tech, metals and mining, potentially energy, which I'm not. Materials, metals and mining, that's the same. Consumer staples, consumer discretionary. Industrials, even REITs. See, there's so many sectors which are really, really strong. They are looking really good. The only two sectors that I would not be encouraged about within the Australian scene is again telecoms, as we have already said, and finance sector. But once again, what's going to happen to this chart in the next week? The chart will do a strong right rotation and punch up into the blue as those finance stocks do their completed inverted head and shoulders, and it'll be a buy. So the diversified financial stocks, which I was holding within finance, have gone absolutely mental, and good on me. So just give me one moment, just so you know what it looks like. Okay, remember I didn't have any banks. I've just been holding diversified financials, and in the past week I had some massive breakouts to the upside. So all looking good, and it's all supporting, hopefully, a good end of the year result. So we've got two markets, two very different markets, but there's opportunities spread within the two major economic regions that I look at, and there's lots of very nice investing to be done. Okay, so just give me one moment. I just want to read Bill's comment. Okay, Bill, that's a technical question that we can have a discussion. Bill's asking me a technical discussion about the interpretation of this chart. Bill, happy to meet you, out of Traders Group. We can discuss that. I have discussed, though, the energies for weeks, and I have been saying it's no mystery. The volume behavior doesn't match this chart, so I'll add to that when we speak. Bill just picked up the word PW. PW represents a synthetic index that my tech built for me to monitor iron ore stocks. So it's just a index that I've got in my Australian chart. And Bill just asked, do you independently monitor iron ore stocks? If so, why? Well, I think it's, because I'm in Western Australia, it's pretty important to understand what's happening in my local economy, and iron ore stocks have a dramatic effect on what happens in Western Australia. Hence, I do like to monitor iron ore stocks within my region, and I made an index up just to give me a sense of what's happening. It does also explain, the reasons why, say, XMM is starting to have a dip, and if it kept on going, maybe I would trim my sales on XMM because although XMM isn't just iron ore, it could be an early warning signal. So, and that early warning signal actually has just gone off. So I actually got to re-examine my metals and mining exposure. Thank you, Bill, in the next week. Okay. Bill, I don't know what the code SSEC is. So Bill writes, also poor performance of SSEC presumably explains the sideward movement of XMM in Australia. Bill, could you just explain? I probably know, I've just forgotten. Oh, the Chinese index. Okay, thank you. I forgot. Okay, it is correct. Okay, so Bill's attributing the sideways movement in China to the slowing down of metals and mining. I don't think that's it. It's more the Trump effect of tariff wars, which I believe is having a dramatic effect on the Chinese at the moment. Okay, I think I've done the rotation charts quite well. Let me go have a look at currencies. Let me come across to FXA, and let me come across to a weekly chart. because we are well aware that on a very large time frame, the Australian dollar has been tracking up the screen for quite a while. We're also aware, if I turn my page back to last week, I wrote down on my pad, about to break trend, less buying volume. So buying volume last week was going negative on this chart. And this week, 1 week down the track, it's now dramatically negative. And we've seen this significant break to the downside. Coming back to the daily chart. So again, we shouldn't be too shocked that we're seeing major weakness within the Australian dollar. And now we're seeing, and I've even put up the Fibonacci extensions, we can now see also that the market has nearly reached 100% extension based on the previous range to the downside. So maybe we would get some sort of level of support come in at 73. If that level of support kicks in, what we will see is some sort of accumulation pattern occur, which is backed by supporting institutional buying volume. At the moment, if you ask me where it's going, obviously I've got to say it's going down. The volume picture is dramatically, nearly 10 times negative compared to last week, and we got this significant break, and we were just breaking trend last week, and it followed through. So, if the Australian dollar has had this major breakdown, we would have to say that the US dollar is the major driver. When we go to the US dollar Australia dollar pair traded on the Australian market, we can see that's true. First of all, we need to put it in perspective by bringing up a weekly chart. When we look at the weekly chart, we can see there's been a major breakout, and also back in January, a higher low. And after the breakout, we've seen another, this is now officially a trend, because there's a series of pullbacks. The recent pullback is now confirmed with this break in the past week. This is a strongly uptrending US dollar, which is supported by significant buying volume in the past week. So it will probably continue into the distant future, and we'll see how she goes. It can't go forever. That said, I'm not going to do any extensions on this. If the Australian dollar is nearly 100% extended to the downside, if I did a bit of work on this, I didn't remember to do it, you'd probably find that this is 100% extended to the upside. In fact, why don't I just do it in real time? Okay, this is what I'm looking for. I'm looking for the last range. I'm looking for the past range to equate to the current range. If I grab the low of the last range, the high of the last range, mark it up, it is very close to being 100% extension. It's nearly identical in reverse to the Australian dollar. So I would not be surprised to see this market have some resistance at that 100% level and some support on the Australian chart, with the corresponding volume telling me that that's it. When I say the words that's it, I don't mean that's it for the end of the trend. I mean that's it for this extension, and it's time to have a little bit of a pullback. The only other US dollar chart that I've got access to is UUP, and UUP is a US dollar index chart, which is a US dollar chart against all currencies, not all currencies, a basket of currency, but within that basket it's dominated by the euro. So this is why we're getting such dramatic effects on those exchange traded fund charts. We've got US dollar against all currencies, obviously, dramatically having an effect. Is this good or bad? It's good. It's good for Australia. It's rotten if you're about to go on overseas holidays to New Zealand. Not New Zealand. It's rotten if you're about to go on a overseas holiday to the United States, because you're losing 30 cents in the dollar. But if you're an importer, if you earn US dollars, which I personally do, I earn US dollars, it's great getting a 30% premium on the money you earn. So this is good for exporters within Australia. We're an exporting country. It's supportive of a growing economy. This is all good. Matched up with Malcolm's tax cuts, if you agree or disagree, it's not actually the tax cuts or the timing, it's the perception of the tax cuts. And those tax cuts, that attracts investment from overseas and may have a psychological shift on the population, and maybe, I don't know whether anyone agrees with me, we've been in a real slump, a real slow moving economy in Australia for about 2 or 3 years now. No, not recessionary, but just grinding along. But that's pretty obvious from the slow wage growth that everyone's talking about. It really needs to start accelerating. And I'm in touch with a lot of people. I mean, this is not, as you know, the only business I earn. It's been a hard grind, and hopefully she'll changes pretty soon. So if the Aussie dollar broke down and the US dollar broke up strongly, and gold is a pseudo currency, I don't think it's going to be a big guess as to what gold did last week. Last week on my pad, I said volume weaken, breakdown coming. And we were watching, starting with a weekly chart on the gold chart, a gradually grinding upward moving low momentum move within the gold. That said, as we looked at the charts last week, we noticed the market was touching the bottom trend line and did a test and retest. And last week, what I was observing is on that retest, there was a shift in volume behavior, which is kind of preemptive of what's about to happen next, and it was correct. The volume behavior within gold has gone significantly negative in the last week, supporting my guess that that's what was about to happen, and it did. So we have now a breakdown in gold, which is going to go wherever it's going to go. I don't got no idea. It's such a messy chart. I don't even want to try and analyze it. I'll have a look at it next week, but it's pretty boring. Brian just said, can we see gold, please? Brian, have you got any specific questions on gold? Maybe you're a gold bug. I just don't, I'm not attracted to the gold chart because of the low momentum nature of this chart. It's just, why would I get involved in gold when I can pick up consumer discretionary and tech, which is going crazy? That doesn't make sense. So any specific questions? Okay, Brian is confirming that he likes physical gold. Well, I like physical gold. Give me some. I'll like it to death. But as far as an investment, I don't think so. There's better places to put my resources and make money quicker, because that's what I'm about, making money faster than everybody else. So I can buy a big boat and sail over to New Zealand. I tell you, I'm going to do that. I will be doing that. Okay, just going quiet for a moment. Before I get off all the big picture stuff, just wanting to look at the internal information surrounding the S&P 500. Last week, advancing and declining stocks were 250 advancing and 191 declining. The previous week, that was 3 weeks ago, was 272 advancing, 216 declining. So you can see they've declined in the last few weeks. This week, there's 233 advancing, 219 declining. Is that in any way abnormal? No, of course it's not abnormal. We're in a counter trend, which I said is probably not complete. Interestingly, but not worryingly, when I look at the volume of these numbers, they're actually equal. In the past few weeks on the extension in the S&P 500, there was a 30% increase over the selling volume in the advancing and declining stocks. So at the moment, they're actually dead even. It's totally normal. Just shifting across to other internal numbers, which tell me that the index is still strong. New highs, new lows. 3 weeks ago, there were 27 new highs, 6 new lows. Last week, 32 new highs, 6 new lows. This week, it's backed off to 24 new highs, 5 new lows. Is it anything unusual? No, it's not unusual. It's just backing off. Absolutely fine. Okay. Bill says, how about sailing to Tasmania? Bill, I'm telling you, I'm going to be in Tasmania. I've got to give you the details. I'll be in my daughter is committed to sail there at Christmas. I've just got to work out how I'm getting there. I will definitely over there and will definitely go out. See if I don't kill myself in Bass Strait driving a support boat, which I hear is pretty rough and I can't wait. The rougher, the better. Okay, so getting off track. I just need to come back to some lists that we looked at earlier this year. Okay, some of the lists were not quite obvious, and I'm talking about lists that I gave you in April. The reason I gave them to you in April was because they were stocks that I was investing in the strongest sector of the market at that particular time, and they were centered around two specific sectors, which are still the strongest sectors today. They were consumer discretionary and they were tech. These were the stocks that I gave you in April, and I think without every single stock, if you had have either invested in them or done whatever you did, you can't have lost money because they've been going through the roof. So Amazon was the top 6 or 7 stocks I could find. Netflix, some of these stocks I absolutely do own, and Netflix is going crazy. With the market pulling back, it breaks into a new high. How do you figure that one? Must be my consumption of Netflix movies. GRUB, which I'm a great user. GRUB, no big break, but you can see what's about to happen. It is breaking, and that's a huge base, and you'll probably find it has a huge extension. SF, and I think I own it. SFLY, looking good. ETSY, huge break to the upside. And IAC, it's just interesting to go back on some of these stocks, had a huge collapse and a recovery. Okay, the top tech stocks I found back in April were SPLK. It's had a gradual grinding move to the upside, triangular pattern at the top. It should resolve itself in a big break to the upside. NOW, very similar to the pattern we saw on Netflix a few weeks ago. NOW grinding up, looking good. SSNC, looking fantastic. PTC, slow upload if you've got a black screen, so have I. Come on. If it does not load quickly, I'm going to flick through. About to give in. Okay, I am giving in. Next one. Okay, it's not the stocks. Okay, here it is. ADBE, very nice stock, gradually punching its way to the upside. Last one was FTNT. So nearly all those stocks, if that was the total sum of your portfolio, you've just made $1 squillion since April this year, which represents the bottom of the W pattern on the S&P 500. Good luck to you if you did anything with those stocks. RUN, this is Mike and his solar stocks, his energy stocks. And if you recall the story that we gave a few weeks ago, that this particular stock was really high momentum because I pointed out that the pullbacks are residing above previous swing highs. Guess what? The pullbacks are still residing above previous swing highs, and it is accelerating, not decelerating. It's getting stronger because the pullbacks are shallower, which tells me this is a real beauty. And I don't know what they're doing. And I'm a mug because I didn't buy any, but I couldn't afford it. All my money's in the market. I didn't have any spare cash anyway. ENPH, looking good, just a little bit slower. Okay, just give me one moment. There were a few, about 2 or 3 weeks ago, I picked once again for traders the strongest stocks within the US market. And I just put up a list of 6. They were GDDY, strong grinding upward move. They might be repeated from the last list. SPLK, not really going anywhere, but it's about to break. It was on the other list. FTNT, come up again. Strong upward grinding move. MA, MasterCard, in tech. Is that tech? Sounds weird. Strong upward grinding move. Once again, it's showing up again. ADBE, strong upward grinding move. It's not surprising that the strongest stocks back in April are still showing up as the strongest stocks today. Okay, XLY, I had 4. ETSY, now I own this. And that's an insane move. I was watching it happen. So I bought it back in April at $28. Now it's 46. And I thought for sure it's going to come back and fill that gap. But it doesn't look like it's going to. Maybe it will. I'm just going to leave it alone. GRUB. Grinding upward move. It's actually on the other list. Netflix, it's on the other list as well. And CVNA. Now, what does that prove? It does prove something to me. Look at that. What it does prove that anyone that's done our investment course, it's based on high momentum stocks. Momentum begets momentum. And the stocks that I picked in April were not identical, but the similar stocks, or a number of them, came up on a search I did only 2 or 3 weeks ago. So it proves the fact that momentum, once established, maintains itself. And in this case, I know it's a very short sample, it's only for months, but it proves a point which I've known for years, that high momentum portfolios continue to be high momentum portfolios for days, weeks, and sometimes years into the future. Okay, Bill's just making a point. And Bill's point is interesting personal point. Many of the stocks I got out of in March haven't recovered. Okay, that is interesting. Bill, I got no idea of what sector they're in. But if you got out of stuff in March, you obviously wouldn't wait to get back in, and you wouldn't be waiting for them to recover. You would switch focus and identify the strongest sectors, as we did in April, and jump in. Alan's asking me a question. What do you use to scan for momentum? Alan, I've been putting it up on the screen for years. It is a sector rotation chart. There you go. That's it. Okay, guys, just give me one moment. I've just got to scan my pad to make sure I haven't missed any points. Okay, I have missed a point. Someone asked me a few weeks ago about oil, no, not oil, natural gas, and I picked it up because it was on our tally. We often get in the west coast of Australia, we get resource-related articles on television, talking about different commodities, and UNG was one that was talked about fairly extensively, and the discussion was that the supply is not going to meet the demand, and the cost on the east coast of Australia is going to go through the roof. They've even talked about running a pipeline from Perth over to the east coast. I don't know whether that's prohibitive or not. What a great idea. I mean, not that we're selling natural gas, that it creates employment for thousands of people across the country. I love these big projects. So last week we drew a saucepan type structure. It's pretty damn ugly, but I can tell you it's well supported by institutional volume behavior. Therefore, if that was your question, it continues to be that's probably going to break to the upside and continue on up. Let me just continually just review my pad. I think I may have covered all the points that I wish to talk about this evening. So that's it. Guys, that's it for this evening. Anyone who's got any questions, please talk to me. But before I go, someone's thrown in a late one. MMJ, is that MMJ? That has to be Australian. That's a marijuana stock, yeah? MMJ, ASX, just stick it up while we're... Alan's just pointing out that it popped up, broke trend. It's really maybe not fundamentally inspired. It's probably, just driven by the technicals of the overall market. So I wouldn't be getting too excited about it. Guys, that's it for this evening. Stay safe. Thank you very much once again. And I look forward to seeing you all the same time next week for the end of the financial year next week. Beautiful. Thank you.